Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, share, and restack buttons. Well, this is a special edition video that we're putting out based on the markets and what's transpiring, the financial turmoil that's taking place. So we're going to reiterate today in this video a lot of what we talked about in Saturday's video with a lot of updates, because there's been a lot of big developments that happened. If you're not on the Substack at brittgillette.substack.com and subscribe to that, maybe you didn't see that video on Saturday, but that's okay, because we're going to cover a lot of the same material today, but we're going to talk about a whole lot more and what's happened since. So if you're new to this channel, and there's probably a lot of new people today drawn in by the title of this video, we've been talking for quite some time about two events, for almost 2 years, two coming events. One is a global depression, and the second is a global financial crisis. Now, those two events can come together as they did in the Great Depression and the Great Financial Crisis, but they don't have to be similarly occurring parallel events, as I believe we're going to see here. So a financial crisis being, let's think of the global depression as a sustained period of low to no growth in the economy. And we'll think of the financial crisis as really a credit event, meaning we've been talking about a time is coming where global credit markets will freeze up and everything will come to a grinding halt. So a very significant event. Are we seeing that now? Well, we're not seeing that happen right now, but I believe, are we seeing the financial crisis? I believe the answer is yes. Now, on Saturday when we talked, I said, well, maybe we have to see what data plays out. But if I had to guess, I'd say yes. I think the more data that's come out, the more that's confirmed. I believe what we're seeing is the opening salvo, the early innings of this credit event that's coming. So we're going to talk about what's happening now, what's set to happen, what's likely to happen in the days ahead, what's next. We're going to talk about, why all of this is happening. Why is all of this happening? And therefore, where is all this going? Not just tomorrow or next week, but ultimately, where is all of this going? So let's start with what's happening. Let's go look at this. This is from CNBC. This is the Dow Jones Industrial Average. Today was down 2.6%. Now, again, you'll hear in the media all this hype, because this is why you shouldn't really trust the mainstream media. All of the radio out segments and the lead-ins to the big news channels, Dow is down 1,000 points, right? Because 1,000 points sounds like this tremendous amount. And, 30 years ago, it probably would have wiped out the entire market. But we really need to be looking at the percentage change. And this historically is not really all that radical of a percentage change. From the market peak less than a month ago, I believe it was an all-time high on the Dow, we're down 6%, right, since then. So not the end of the world, but as we talk about what's going on, we're closer to the end of the world than we are to nothing to be concerned about. How about the S&P 500? Again, down 3%. Overall, the S&P 500 also hit an all-time high. Most of these things were around the second week of July globally, all of these markets hitting all-time highs. There's been a steep drop-off since. The S&P is only down 8.5% since its all-time high less than a month ago. Again, not the end of the world. And we get to the NASDAQ. Again, the NASDAQ down today 3.43% from its all-time high, down 13.1%. So now we're starting to talk, getting toward correction territory. This is a sell-off, a downturn. But then we get into other markets outside of the United States, and we look at the Nikkei index, which They put the unchanged here. That was down, I believe, 12% earlier today. It's down 25.5% in less than a month from where it was at an all-time high. And both today or earlier today, I believe this market will open at 8 p.m. Eastern time. Again, we'll see in this video may be coming out probably around that time. So we'll be able to monitor in live time how that's doing. But between Friday and Monday, the drop in the Nikkei was the biggest two-day drop in the history of Japanese stock markets. So we're talking, this is the Japanese equivalent of the 1929 crash, essentially. So this is a big deal. We'll be watching this. We have the Kospi index. This is over in South Korea. That was down, I believe, 8% earlier this morning, down 15.5% from its all-time high earlier in the month. Again, they've got that unchanged because that will open here very shortly, maybe when this video comes out. What else did we have today? Well, we had all the crypto space was down across the board. We had Bitcoin as of right now. These are real-time markets that never close. So got Bitcoin down 8%, Ethereum 11%, XRP down 8%. So down across the board. Similar with gold and silver. Again, they switched these to unchanged now, but gold, silver, copper, platinum, palladium, all down today. Oil was also down today, slightly. But to me, that shows just how big of a sell-off this is. And again, we're going to talk about why it was the selling of virtually everything, because right now we're on the cusp of war in the Middle East. And maybe that's occurring again as this video is released. I don't know. As of right now, we don't have war in the Middle East that has, and this is the key, disrupted the free flow of oil at market prices. If we have that, if we have an event that leads to that, guys, all of these markets, what happened today, nobody will even remember it. It'll be a blip on the radar compared to what would come if we have a disruption of oil supplies coming from the Middle East. So again, with that, to see oil sell off, hey, means people are just selling everything, trying to get their hands on cash. But it also tells me that the economy is such that they're looking at, okay, what are the prospects of war driving oil up? What are the prospects of lower demand causing the price of oil to go down? And lower demand won out. Again, people were selling off everything. So I'm going to take a look at this as well. We looked at this on Saturday. So this is from CME Group. And they look at the odds of the U.S. Federal Reserve lowering rates at their next meeting, at the September 18th meeting. So what are the probabilities? Well, they have a 0.5 point rate cut, or 50 basis points, priced in at an 83% probability come September. Now, that was a week ago, 11%. And earlier this morning, they had a 75 basis point, or 0.75, 3/4 of a percentage point rate cut was priced in at maybe 10% odds for a little bit until that went away. But this shows the shift in market sentiment that occurred last week as it became clear to many market participants that no, the Fed isn't bringing us in for a soft landing or no landing. I read one commentator this morning that said we went from no landing to now it's going to be a soft landing. And that's led to this, all of this turmoil, and guy has no idea what's coming. No, we're heading in for a crash landing. So if you remember, we looked at this chart back when it was down here. So what we're looking at is the Fed funds effective rate. So when the Fed raised rates from 0% or near 0% to where they are now, between 5.25% and 5.5%, not a big deal historically. You had much higher Fed funds rates 40 years ago, way higher. But from a percentage basis, when you're hiking to that level from near zero, the percentage change year over year, which is the chart we're looking at now, is astronomical. So this data goes back to 1955. And as you can see, probably right around here, 410% year over year back in 1959 was the all-time high in this data series. Nothing ever got anywhere close to that. Well, last February it hit 5,612.5%, which I said at the time creates this mountain, and the Federal Reserve is flying the global economy. The global economy is a plane, and they think they're bringing us into a soft landing. I think the airport they're looking at's over here, and there's this giant mountain in the way, and they're going to crash the whole thing into the side of it. That's where we're headed. So these rate hikes take anywhere from 12 to 18 months to work their way through the economy. So again, the last one was, I believe, almost a year ago. So we're still feeling the effects of those rate hikes. And of course, the peak of this was almost exactly 18 months ago. And lo and behold, what's happening right now? The whole thing's falling apart. So let's look at this, because we have been talking about this for well over a year, that this is the key metric to watch. So this is the 2-year, 10-year spread in U.S. Treasuries. This is also known as the yield curve. And when the yield curve goes inverted, which it did back in July 2022, historically, going back to the 1950s, it's always been a precursor to recession and economic downturn. And we said in the past, I believe we're already in that depression. I believe it began many months ago. Time will tell. They usually don't know until long after, and they backdate these things and say it started back here. Who knows exactly when that started? But typically we see them start, and we see the markets recognize that economic downturn when we see the yield curve uninvert, meaning this number will go positive, because this has been negative again since July 2022. And I've been saying, when we see it go positive and stay there for several days or a week or so, we're going to know the crisis has arrived. Well, we're still negative, as you can see, but today, earlier this morning, for maybe like 20 minutes, this metric went positive for the first time in over 2 years. So my guess is sometime in the next week, we're going to see this go positive and stay positive. If this is the financial crisis that we've been warning about, then that is what we will see, and that will be our indication. It will be further confirmation, along with all these other data points that we're going to look at today, that the crisis has arrived. So what else do we see? Well, let's take a look at this chart right here. This is the VIX, which measures volatility in the markets. It finished today at 38.5. Intraday, it went up as high as 65. To put it in perspective, a month ago it was 12. But when you look at, this is the highest this has been since the COVID crash, the COVID market meltdowns in March 2020. And before that, the great financial crisis, the failure of Lehman Brothers back in September 2008. So this is a key indication, what we're seeing here, that this is more than a market sell-off. This is likely the credit event financial crisis that we've been anticipating, because these spikes in the VIX tend to coincide with those credit events, those market events. So again, we will see how this plays out in due time, and we're going to talk about why all this is happening very shortly. But first, I think this is a key talking about volatility, this is a key point, a key takeaway that I want people to have here today. Because a lot of people will look at these headline numbers and they'll hear what the media says, oh, the Dow was down 1,000, and not have the proper perspective. I don't know what's going to happen tomorrow. I think there's a very, very, very low probability to almost non-existent probability that tomorrow the markets are tranquil. They don't really go up or down all that much. It's just sort of where it is today. I think we're either going to see, in all likelihood, a really high market, a surge, the market goes up a lot, or we see another surge downward and the market goes down a lot. And I want to point that out because those types of volatile markets are indications of declining markets. The market tends to go up very slowly. What they say on Wall Street is the market goes up by the stairwell and then down through the elevator, or down by jumping out the window. Because, in other words, the market goes down very quickly. You're not going to, these up days, so we may very well have a big up day. We may finish up for the week. That is not a sign that the crisis is over, that it's been abated, it's all is well. Far from it. If you see these big up days along with the down days, that's an indication that we're in the middle of really a bear market decline. Anybody that lived through the dot-com bust or the great financial crisis, the 2020 COVID sell-off, will recognize that. And just to show you historically, let's take a look at this right here. This is on Wikipedia, and it has the list of the largest daily changes in the Dow Jones Industrial Average. And so we look over here at the biggest down days of all time. So you have Black Monday, 1987 was the biggest one-day downturn in the Dow ever. Then you have here the COVID crash, the Great Depression, the COVID crash, the Great Depression, a panic back in 1899, the Great Depression, panic of 1907, the aftermath of Black Monday, 1987, 2008 Great Financial Crisis, the Great Depression, COVID sell-off, Great Depression, Great Financial Crisis, Great Financial Crisis. You get the point. The biggest sell-offs are at these big events, these big turning points. Great Depression, Great Financial Crisis, the COVID sell-off. But many people tend to think, well, the biggest up days coincide with these good events that may take place. But no, they also coincide with these events. So if we look at the biggest up days in the Dow, we see they happen during the Great Depression, Great Depression, Great Depression. The COVID market sell-off in March 2020, Great Depression, Great Financial Crisis, Great Financial Crisis. 1987, Black Monday, the aftermath. This is just, 2 days later. We had the Great Depression, COVID sell-off, Great Depression, Great Depression, Great Depression, Great Depression, Great Depression, on and on. So you are likely to see in the days and weeks ahead some of the biggest up moves in the market, as well as some of the biggest down moves in the market. And again, we want to be looking at those in percentage terms, not point terms, because see, if you see here, the Dow went up 15% back in 1933. That was only 8 points. It went up 11 points back in 2020, and that was 2,112 points. So the news media likes to talk about points because it sounds big, but we want to look at percentages. That's what you want to make sure that you are focused on. So we talked about what's going on, a little bit of what you should expect in the week ahead, because I believe, again, we're going to see continued volatility, and we'll talk more about that in a moment. But why is all of this happening? And we're going to look at several reasons why this is happening, why it's not short-lived, why they're not going to fix this week, as many people may think. It may even appear that they fixed it. They have not. It's going to get worse. And there's several reasons. We can't go into all of them, but we'll go into the biggest reasons why this is happening right here. So let's start right here with the US dollar, Japanese yen exchange rate. So this chart right here, it tells us as of right now, when I'm recording this, in order to get $1, you have to provide 143.82 Japanese yen in exchange for $1. Now, this, just a few weeks ago on July 10th, was as high as 161.82 for the dollar. So we have gone in a matter of really days when you talk about trading sessions, but less than 4 weeks, less than a month, from a high of 162 down to 143.8. This was, I believe, down as low as 142 earlier today. And this is basically the result of, in a nutshell, a short squeeze. We saw something similar happen with GameStop stock about 3 years ago that made all the headlines when it went from $4 to $400 in a very short time period. We're seeing the same thing happen here, and it's something we've been talking about for quite some time. I know back in April we actually pointed to this 162 level as a level that likely would cause the Bank of Japan to intervene on behalf of the yen to defend the yen, and could cause an unraveling of what's called the yen carry trade. So what is the yen carry trade? Because a lot of what we're seeing today, we can't attribute all of it, but the good portion of what we're seeing today and last week, what is the unraveling of this yen carry trade. So let's look at this tweet right here by the Kobo letter. I think this is a good, succinct, easy to understand way to relate to this, and I'll add to it if I think that it helps clarify what this is. But it says, stock markets around the world are crashing right now, but why? The answer to this question is the yen carry trade, a term you'll probably hear many times this week. And again, if you've been watching this channel, I believe at the time when we were pointing this out, we said one day in the near future, all the financial media is going to be talking about this. This is going to be in the headlines, and here we are. So what exactly is the yen carry trade, and why did it cause a market downturn? A thread to explain. It says it all started after the Bank of Japan decided to raise rates at their most recent meeting. This was last Wednesday. The Bank of Japan raised rates to around 0.25 percentage point. Which is absurd when you sit back and look at this. Because all of this, guys, is the result of central bank intervention and interference with the free market, and it's created all this built-up pressure, similar to if you took a beach ball and pushed it under the pool water as far as you could, and then, you lost control of it, and it's going to shoot to the surface very quickly. It's essentially what happened here. We're seeing the free market assert itself against these anti-market forces of the central bank. So it says, for years, traders took advantage of these ultra low rates. So the reason the Bank of Japan is doing this, Japan has, I believe, somewhere around 264% debt to GDP ratio. So when we look at the United States has $35 trillion in debt, and everybody says, oh, that's awful, that's terrible, and it is. Well, that's, I think, right now around 120% debt to GDP ratio for the United States. So Japan is more than twice as worse off as the United States, as bad as the United States is. Well, if they allowed the free market to determine the yield that they paid on their bonds, on their government debt, let's say the government debt was just, say, 3%, the amount of interest Japan would have to pay on that would bankrupt the nation. So as a, quote, solution to that, the Bank of Japan has simply printed yen out of thin air, and they go out into the market and they buy those Japanese government bonds to suppress the interest rate down to here 0.25%. At one point, they were negative rates. And so that's caused all sorts of distortions in the market. The yen carry trade is one of those. So this goes on. It says the yen carry trade explained. For years, investors would borrow yen at ultra low rates, such as 0.4%. So imagine if you had a mortgage at 0.4%. A lot of people would be happy with that. So you can go out, you can borrow these yen at 0.4% and use these yen as a form of leverage. Investors could convert these yen to US dollars or other currencies to get almost free margin, meaning they're borrowing. That's what margin means in the stock world, is essentially you're taking out a loan, right? You're taking out a loan with your brokerage so that you can buy stocks or bonds or other financial instruments. Low rates made all of this possible. It says the wide spread between rapidly rising rates in the US and other countries and negative rates in Japan made it possible. However, as the Bank of Japan began raising rates, this resulted in an unwinding of the carry trade, especially as rate cuts are beginning in the US and the EU. As a result, the Japanese yen strengthened, and the US dollar Japanese yen currency pair just hit its lowest level since December 2023. And this is just weeks after it hit its highest level since, I believe, 1984. You now receive 142 yen for every US dollar compared to 160 yen for every dollar just a few weeks ago. But here's why this is the key point. As the yen strengthens, many of these yen carry trades are being margin called. So when you have a margin call, that's when you've borrowed from the broker. The trade you've made isn't going your way, and they say, give us more cash, or you have to sell, because otherwise we're taking major risk that you're never going to pay us back. And so you either have to sell, which is what we've been seeing, these forced liquidations, or you have to put up more cash, which oftentimes the people putting on these trades don't have because they're trying to maximize their returns. So they're forced to sell these things. It says suddenly the era of free yen loans is coming to an end. As these margin loans are called, the underlying assets are being sold and crashing equity markets. The carry trade is unwinding. So essentially, what's happening is they've sold yen short. It's a good way of putting it. You sold the yen with a promise to buy it back later, and you're hoping you can buy it back later for less than what you sold it for, right? Pocket the difference. So you're hoping that it's 180 to the dollar or 200 to the dollar or something like that. But if it goes the other way, well, now you're out of luck and you're forced to sell. You get a margin call on that. They call you up and say, put up more cash, or you got to unwind this trade and pay us back. And so they're having to unwind these trades and sell off the assets they bought all over the world. So that, in a nutshell, is what's happening here. And I would say those people should have read the Bible, and they would have read this from Proverbs 22, verse 7. Just as the rich rule the poor, so the borrower is servant to the lender. So we're witnessing firsthand biblical principles playing out in the real world as borrowers are getting margin called by their lenders, and they're becoming servants to the lenders. They're having to sell. So guys, this is really at the heart of what we're seeing in the markets right now, is the unraveling of this yen carry trade. I believe it's going to go on for maybe several weeks. We quite possibly, not quite possibly, but we almost certainly will see central banks intervene. So the question becomes, how do they intervene? Talk about that in a moment, because I think the way that many people think they'll intervene and the way they may intervene will actually make the situation worse. So never underestimate the stupidity of these people in charge, the central bankers and the politicians. So we'll get to that in just a moment. But what else is going on out there? Well, we looked at this a couple of months ago. This is from Florida Atlantic University, and they did a study on commercial real estate exposure at U.S. banks. And in doing that, they pointed out that each bank's commercial real estate exposure, meaning the amount of loans they've put out there and underpinning commercial real estate transactions, as a percentage of the bank's total equity, meaning what's the bank worth, bank regulators view any ratio over 300% as excess exposure to commercial real estate. So we don't need to understand all of that to know if it's over 300%, that puts the bank at greater risk of failure, according to regulators. So you don't want to be 300% or higher. That puts you at greater risk of failure. So is anybody sitting there? Well, it turns out 1,871 banks have total commercial real estate exposure greater than 300%. 1,112, and I believe that this isn't in addition to, I think, as a subset of that 1870. So it's 1871 total. But of those, 1,112 have exposures greater than 400%. 551 greater than 500%, and 243 have exposures greater than 600%. So twice as bad as regulators say puts the bank at greater risk of failure. So that's the state of the banking system right now in the United States against the backdrop of all that's happening right now in markets. And this also happened last week. So this tweet says this, meaning this picture right here. This is a picture of 135 West 50th Street in New York City. In 2006, this building sold for $332 million. Yesterday, which would have been Wednesday of last week, it sold for $8.5 million at auction. So if you're doing the calculations, that's a 97% loss on that loan, whatever bank lent the $332 million. I mean, some of that was probably paid back over the course of the last 18 years. Who knows what's at stake in this transaction? But the point is, this is not an isolated incident. It may be an isolated incident and a loss of 97% of the market value of this building, but we're seeing 80, 90, 70% losses on commercial real estate properties all over the United States and really all over the world, because post-COVID, these buildings generally aren't filled with work from home. And so the cash flow isn't there. With higher interest rates, these properties have to be refinanced at a higher rate that doesn't make sense anymore. So it's driving the value down. And most people don't realize these properties, they don't get a 30-year fixed mortgage like you might have with a house. They're financed on usually a 5-year basis. And 87% of these loans are interest only, meaning none of the principal is being paid down over the life of that loan. We saw what that did during the great financial crisis and how that worked out. It didn't work out too well. And so this is a strain on the banking system. And we add to that backdrop things like this. So here we had this from Friday on Zero Hedge mentioning Warren Buffett's Bank of America dump-a-thon grows by another 19 million shares. So Warren Buffett, as of Friday, as far as we had known, it may be more, had sold 90 million Bank of America shares. So it comes out to $3.6 billion worth of Bank of America shares. Then come to find out over the weekend, it's revealed that Berkshire Hathaway, which is Warren Buffett's company, again, Warren Buffett, if you don't know, is widely considered the greatest investor alive today. Berkshire Hathaway is one of the greatest companies in the world. And they sold more than half of their Apple shares that they owned at the beginning of the year up until the present. So Warren Buffett, the world's smartest investor, has been unloading Bank of America, unloading Apple, most likely getting ready for the market downturn we're beginning to see right now. But in banks in particular, see, trying to get out of Bank of America in particular. Well, it's an isolated incident, maybe not such a big deal, but we also see this from Fortune from back in April, I believe it was, that Jamie Dimon, who is president and CEO of JP Morgan, largest, most systemically important bank in the entire world, sold JP Morgan stock, bringing his total share of sales this year to $183 million. Now, this is significant. Jamie Dimon became president and CEO of JP Morgan back in 2006. He was there during the worst bottom of the great financial crisis. Up until this year, he had never sold a share of JP Morgan. Now he's selling. Why? If he thought JP Morgan's going to have a banner year and the bank's in great shape and everything's going to be wonderful, would he be selling? Maybe. Maybe he's got some personal items that he needs to tend to, but odds are he knows what's coming and he's getting out, just as Warren Buffett is. What is coming? Well, we've been looking at this as well. This is from the FDIC itself. This is unrealized gains on investment securities held by U.S. banks as of the end of the first quarter. So this is as of March 31st. The end of this month, we'll probably get the updated data that'll take us to the end of June. But right now, we're looking at banks with $500 billion worth of unrealized losses. No big deal, right? For some perspective, right here, these unrealized losses, this was the great financial crisis. That was the position of banks then. This was right before COVID, maybe even the reason they had COVID, so that they could bail out the banks from this. This is where we're at right now. And that's after we took out the second, third, and fourth largest bank failures in U.S. history a year ago. We had Silicon Valley Bank, First Republic Bank, and Signature Bank all fail. So they were absorbed or bailed out, whatever it was, and these unrealized losses sort of disappeared along with it, or else we'd be much worse off here. But guys, that's where we sit right now. And keep in mind, on top of all of this, we mentioned JP Morgan, there's all these derivatives. We don't even really know what's out there. These derivatives are basically, and to sum it up in real simple terms, they're gambling bets on what's going to happen in the economy. And various financial institutions, they'll make a bet, oh, well, I think this will happen. Well, I think that'll happen. And they'll insure each other against the bet going one way or another, and they say, oh, it all cancels out, no big deal. But it is a big deal, because if the person who assured you they would pay you if your bet went wrong can't pay you, you lose big. That's called counterparty risk. It's what almost took down the financial system back during the great financial crisis, when Lehman Brothers was allowed to just go bankrupt and wasn't bailed out by the government. Everyone they owed money to, everyone who was a counterparty who thought that, oh, Lehman Brothers is going to pay me in the event this bad thing happens, they were out of luck. And so contagion spread through the global financial system as a result. Well, there's anywhere between $1 and $4 quadrillion in derivatives estimated out there. That's many times the size of all the stock markets and bond markets in the world combined. And yet, according to the comptroller of the currency, 87% of those derivatives, 87.6 to be specific, are carried by just 4 banks. Meaning, those banks, I believe, are, well, JP Morgan's one, I believe Citigroup, Bank of America, and Goldman Sachs. I think those are the 4. But anyway, just think of what happens if one of those banks goes down. Well, they won't allow that to happen because it would just blow up everything. But that's the precarious situation we find ourselves in today. So, what's next? What do we have on the agenda next? Well, we have this from David Durking on Twitter. He says, high yield credit spreads are blowing up. So this is what we would expect to see with that VIX elevated, with the volatility. This means that the credit event is coming, that people are selling off the debt they think is less likely to pay off. They go, oh, I might get stuck with this I want to de-risk myself from this counterparty risk. So they're selling off the debt that they think might go bad. And that's usually high yield debt. It's going to make the yields go higher. So again, we talked about all of this just a few weeks ago in May, and 6 potential triggers for the next global financial crisis. And we're checking them all off now. Chinese property market meltdown. If you watched the video earlier today at 1 o'clock, we went over why the parallels we're seeing between the Great Depression and what happened in the Great Depression, the conditions that were in place, and what's happening in China right now. China is in the midst of a deflationary spiral akin to the Great Depression and what we saw at that time. So we're seeing that happen. Japanese currency crisis. Guess what? That's what we're watching in the markets today, including the reversal or unraveling of the yen carry trade, which we talked about at that time and before that as well. German deindustrialization, that's been going on nonstop for 2 years. U.S. commercial real estate crash. Well, you have a $332 million building that 18 years later sells for $8 million. That's definitely a commercial real estate crash. We're seeing that play out. So what else is on that list? What are triggers 5 and 6? Well, widespread bank failures. I believe that's coming. We're going to see that. We'll talk about that more in just a second. And the rapture. And I don't know when the rapture is going to occur. I don't know if I'm not saying it's going to come right after the bank failures or before the bank failures. I have no idea. But just like a war in the Middle East that stops the free flow of oil at market prices would crash the markets overnight, the rapture of the church would also crash the markets overnight. So we've got 6 things on our list, and 4 of them are checked off. 5 and 6 are on the way. We just don't know when, right? But 4 is enough to crash the markets from where we're at. So if you're interested in following all this, make sure to go over to the Substack at brittgillette.substack.com. Click on the Notes tab up top, and you'll see notes like this, because we've been following this, again, for 2 years, for several months. Again, we talked specifically about what's happening right now back on the 25th, so that was 11 days ago. Is this crisis playing out as we speak? Oil, stocks, precious metals, crypto are all down while the Japanese yen is up as I write this. So we were seeing it then, paying attention to it, going, is this it? Well, it's it. It was it. We've seen it coming. So if you want to be ahead of the curve, make sure you're on the Substack checking out the notes, because you won't get the notes as part of the email. They're just thoughts. It's similar to Twitter. I'm just posting whatever I might be thinking about at the time, videos I'm watching, articles I'm reading, thoughts that come into my head. It's all over the place, but it'll be over there on the Substack notes. So what's next? Well, let's take a look at this right here. This is also from the Kobayashi letter. That's who had that overview on the yen carry trade we looked at that was so excellent. It says, breaking, bond markets are now pricing in a 60% chance of an emergency interest rate cut within 1 week. This would mark the first emergency interest rate cut since March 2020 during the pandemic. Bond markets are saying that something broke. And that's true. We see that yen carry trade is unraveling. Who knows what's breaking behind the scenes? But let me tell you this, a lot of people are actually calling for, we need a rate cut. We need an emergency rate cut. Where's the Fed? We've seen Jeremy Siegel and Elizabeth Warren, all these other people saying, cut rates right now, Jerome Powell. That would actually make the problem worse because, again, the yen carry trade is precipitated. It's allowed to exist based on these lower Japanese interest rates over here and higher rates, higher yields that you're getting on investments over here. When the Bank of Japan decided to hike rates, that lowered that spread and helped unravel, led to some of those margin calls. If you cut rates in the US, that also contracts that spread between the yen and the dollar, and it actually pushes for a further short squeeze on the yen-dollar trade. It would make it worse. So but don't underestimate the stupidity of the central bankers. They may very well do that. And when they do that, the headlines will go out, oh, the Fed cut, isn't it wonderful? And you'll probably see the markets go up. And they'll be like, oh, the markets are up 8% or something like that. And again, we looked at before, when that happens, that's not a good thing. That's usually a sign that of this wild volatility on the way down. And I don't know how long that euphoria will last. Will it last 30 minutes, 5 hours, 5 days? I don't know. But I think it'll soon be recognized that, wait, no, this makes it worse. I don't think it'll last 5 days. Probably last about 30 minutes is my best guess. And then we'll see a complete reversal of that and a massive sell-off again. And at that point, the Fed sort of played its hand and they go into full-blown panic mode, which they'll start doing all sorts of other things, which is just going to make the market even more panicked. So I've made some notes because I know what people want to know, what's likely to happen next. High volatility. Expect high volatility in the days and weeks ahead. Behind the scenes, we have no idea what's going on. There could be some black swan event that was triggered as a result of all of this, because when you have these massive changes in markets, who knows who was doing what that just got broken. For instance, back in 2008, we had Bernie Madoff was running a Ponzi scheme, right? And nobody knew that until the markets became dislocated and that was discovered and a light was shined on that. So Fed cuts will likely make it worse. What's after that? Probably, I would say, bank runs. Now, I don't think there's going to be bank runs in the United States this week. I would say if any happen this week, it'll likely be in Japan. Because again, we look at the problems that led to Silicon Valley Bank. They had all of this government debt and mortgages that were low interest rates. When the interest rates went up, the value of their portfolio went down, and they had those unrealized losses that became realized losses when depositors came to the bank and said, give me my cash. And then the bank was finished. The same thing is happening right now in Japan. Japan had decades of low interest rate policies, negative interest rate policies, and the banking system in Japan is holding on to all of this low interest trash, essentially. And with the interest rates going up, with the yen appreciating, that's putting pressure on their portfolios. They have massive unrealized losses, which we probably can't even comprehend right now, but we will when the people in Japan say, I'm going to the bank and I'm going to demand my cash. So look for bank runs to come to Japan first. Then you're likely to see those spread throughout the world. I'm not putting a time horizon on this of this is going to happen this week. So don't get confused by this. I think you've got plenty of time to prepare for this. But what's going to happen is when people start, then when that comes back to the United States as it was last spring, back then, they ignored the law and they bailed out those banks. The law says you have to bail in the failing bank. That was legislation that came after the great financial crisis as part of the Dodd-Frank bill. So what's going to happen? There will be a bank at some point in the United States that's where the Federal Reserve says, well, you know, there's nobody at that bank with a deposit who's politically connected. So it'll be a bank you and I bank at, right? We're the depositors, one of those banks. So let's follow the law on that one, and we'll bail it in, which means anybody who has above the FDIC limit of $250,000 is now going to become a proud owner of a failed financial institution. So everything above that $250,000 is going to be converted into equity in a bank, in a worthless bank, meaning now you get pieces of paper that say you own a bank that's not worth anything. And you may say, well, no big deal, Britt. I don't have $250,000 in the bank. Yes, but many businesses do. Many businesses have their payroll at the local bank, and it's in excess of $250,000. And if that bank issues a bail-in, that business will likely go bankrupt, and its employees won't get paychecks. And maybe you say, well, I still don't care because I'm retired. Well, your child, your grandchild, your neighbor, that may be their business. And then when that business goes out of business, they probably owe debts to other businesses in the area. So you can see how this spreads. But more important than the immediate impact of those businesses and individuals in the community that are affected by that bail-in is once you have one bail-in, just one, that will be the equivalent of Lehman Brothers in 2008, because everybody who has more than $250,000 in a bank, business, individual, anywhere, is going to run to the bank. Well, they'll run to their computer or their phone, and they'll transfer all of that cash to likely JP Morgan or some other bank that they deem too big to fail, because it's going to cause a run on the banks. It's going to cause a lot of these banks to collapse. We just looked at 1,871 banks are at risk of failure just from commercial real estate exposure. What happens when all the businesses they transact with say, I'm moving my payroll from you to JP Morgan? They're gone. Overnight, we have a major, major crisis. What happens then? Well, we have this. Bank holiday in 1933. For an entire week in March 1933, all banking transactions were suspended in an effort to stem bank failures and ultimately restore confidence in the financial system. When that happens, everything shuts down. Credit markets all over the world will freeze, as no institution will want to lend money to another institution for fear that they won't be paid back. That's called counterparty risk. It almost led to frozen markets in 1998 with the failure of long-term capital management. Almost happened in 2008 with the failure of Lehman Brothers. We were on the brink of that, probably hours away in both instances. Well, probably, again, if a bank bail-in is that credit event, then it'll happen too quickly for them to react. The politicians and the central bankers to where they're going to have to shut everything down and have this bank holiday to try to patch things back together to reopen. So we've been talking, and hopefully many of you I know have prepared. When that day comes, again, credit is the lifeblood of the financial system. Nothing in the financial system moves without credit. So if credit disappears, everything shuts down. That means the truck doesn't come to the gas station, the truck doesn't come to the grocery store, the truck doesn't come to the restaurant, the truck doesn't come to the retail outlet. So you will be stuck with whatever you have on hand at your house, or whatever you can buy in one last-ditch effort if you get to the store before everybody else. But it'll be gone very quickly. Think of what happened during COVID. Think of what happens when a hurricane comes. The store shelves will be wiped clean. Make sure you have a deep pantry. That won't last forever. I don't know how long it'll last. A week, 2 weeks, 3 weeks, I don't know. It's not going to last a year. We're not going to have a complete meltdown of society. But we're going to have problems, and you want to be prepared for that. So in an effort to be resilient, look around you and think, what if I didn't have this? Maybe I should get it now while I can get it. And then I'll be in a decent shape when this comes, and then I'll be able to be a light to others. Maybe I can bless others with the abundance that I have. What else is coming? Well, ultimately, this is coming. They needed a crisis to roll out the COVID shot. Now they will need a crisis to roll out central bank digital currency. At the end of all of this, the chaos that ensues, they're going to roll out central bank digital currency, tokenized assets, and digital IDs in order to create a system where they can control everything, because ultimately this is the end of the current monetary financial system. The whole thing, it's a big Ponzi scheme. It's going to come crashing down. They've already set up the replacement so that they can stay in control. And the replacement is central bank digital currencies, tokenized assets, digital IDs. Again, this isn't going to happen next week, but this is what's coming at the end of this crisis, however long it takes to play out, which may be some time. I don't know. Again, I think the Depression, most will last about 2 years. Who knows if we're taken up in the rapture before then? I don't know how all of this plays out on a timeline scale, but pretty confident this is where things are going. The Bible tells us, Revelation chapter 13, verses 16 through 17, that the mark of the beast system is coming. And what we see here with central bank digital currency and tokenized assets and digital IDs is indistinguishable in its function and capabilities from the mark of the beast system. So we have every reason to believe that that's what they're going to push as a result of this. What else could be coming? Well, Gerald Celente, he's author of the Trends Journal, the Financial Trends Journal. He says, he's fond of saying, when all else fails, they send you to war. So I put a bunch of big war with a bunch of question marks after it. Maybe war is the way they cover this up. They might actually embrace war in the Middle East right now so that they can blame that for decades of terrible decisions by politicians and central bankers. And they can go, well, it wasn't us. It wasn't our terrible system and decisions that led to this. It was that war in the Middle East, right? And so again, just as the financial system runs on credit, nothing moves in the financial system without credit. Nothing moves in the economy without energy. And a disruption of oil, the free flow of oil at market prices, will crash all of it overnight if we see that, which again, I don't know, maybe that's happening while this video airs. I don't know. All of this stuff is moment to moment. So we want to keep our eyes on the Middle East for many reasons, that being one of them. So guys, this is a long video. We're there, but my thought is this is probably going to continue to play out over the next several days. So it's going to be a different week. Usually I do videos Monday, Wednesday, Friday, and I do an article on Tuesday. I think that's going to go out the window in favor of this format, usually in the evening until, maybe this does go away and it's not the financial crisis we've been talking about. If so, then things will go back to the normal schedule. But God willing, I'm going to try to do these every night to keep you updated on what's happening on the ground and what's going on out there. Because this, I believe, is a historic event that we're witnessing. So, and I think we're just in the very early stages of it. So, God willing, be on the lookout for more videos starting tomorrow. and leave your comments below. Let me know what you think. Make sure to hit the like, share, subscribe, restack buttons. Share this with your friends and family so that they also understand what is coming. And God willing, I will see you tomorrow. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles, as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.